Welcome to this explainer. Look, the insurance sector has just absolutely exploded lately, which, hey, is great for having choices, but let's be real, it is incredibly noisy, especially if you're buying for the very first time. So today, we are going to cut right through all that noise. We're breaking down a straightforward, consultant-level playbook pulled straight from our source material on exactly how to buy term insurance. But before we get into the mechanics of it all, I want you to ask yourself a pretty tough question. Is your family financially secure if the unexpected happens? I mean, that right there is the entire reason we're diving into this today. Our primary goal, our only real goal here, is ensuring that your dependents maintain their financial stability no matter what curveballs life throws. So keep that core purpose in mind as we go. All right, let's dive in. All right, here's our game plan for this explainer. First, the basics of term insurance. Then, key policy characteristics, followed by types of term plans. After that, we'll hit riders and add-ons, and finally, wrap up with some absolutely essential buying strategies. Let's kick things off with Section 1, the basics of term insurance. You know, what's really fascinating here is just how simple this foundational concept actually is. Essentially, term insurance is a very straightforward protection plan. If the worst happens and a mishap occurs during your policy term, the plan pays a lump sum right to your beneficiaries. But, and this is a big but, unless you specifically buy a premium return policy, there are absolutely zero survival benefits, meaning if you outlive the term, there's no payout at the end. It is literally pure, unadulterated protection. And honestly, that is exactly why term plans are so incredibly pocket-friendly. Think about it. With other policies like, say, money-back plans or endowment policies, you're paying a premium for built-in investment features. But with term insurance, your premiums go solely toward mortality charges. There's no fancy investment component tacked on, which means you get remarkably low costs for a massive financial safety net. It's a huge bang for your buck. Moving right along to Section 2, key policy characteristics. First up, the numbers 18 to 65. So this is the standard entry age bracket for purchasing a term insurance plan. Simply put, if your age falls anywhere within this range, you're eligible to enter into a policy. Pretty straightforward. Next, we have 75 to 80 years of age. Now, this represents the ideal maturity age, basically the period when the policy actually expires. So let's think about tenure for a second. If you're, say, a 50-year-old buyer, you'd ideally want to seek a tenure of 30 years so that your policy naturally matures when you hit 80. As a general rule of thumb, you always want to secure the absolute maximum tenure the insurance company will allow for your specific age. That way, you're maximizing your coverage window. All right, let's look at a few more essential metrics you definitely need to know. First, the sum assured. This is just industry jargon for the actual amount payable to your nominees after your passing. Then we have the claim settlement ratio. Guys, this one is absolutely crucial. It tells you the percentage of claims that an insurer actually pays out. You always want to look for an insurer with a high claim settlement ratio. I mean, what's the point of insurance if they don't pay out, right? And finally, just be prepared for health checks. Insurers are almost certainly going to ask you to undergo comprehensive medical screenings, things like blood work and HIV tests, especially as you get older, before they'll even approve your plan. Okay, on to Section 3, types of term plans. So term insurance actually comes in a few different flavors. It's not totally one size fits all. First, there's the level term plan. That's your standard fixed coverage that just pays out a clean lump sum. Second, you've got increasing or decreasing plans. Just like it sounds, the sum assured actually changes each year by a specific percentage. And finally, monthly income plans. With this one, instead of getting one giant lump sum, the insurer pays out steady monthly installments. It acts almost like a salary replacement for your family, which can be incredibly helpful for budgeting. That brings us to Section 4, riders and add-ons. The best way to think of riders is like optional upgrades for your policy. They provide extra financial benefits under very specific conditions. For example, let's say you have a plan with a 50 lakh payout. Well, if you tack on an accidental death rider, your beneficiaries still get that 50 lakhs if you pass away, but they would get an additional 25 lakhs if the death was specifically caused by an accident. So it's really about targeted security. Here are a few of the most common rider options you're going to see out there. A monthly income rider pays a monthly salary to your family for a specific number of years, and sometimes you can even get an escalating variant, meaning the income actually increases every year to help fight inflation. Then there are accidental disability riders, which offer an extra sum if an accident leaves you with either a temporary or permanent disability. And finally, premium waivers. Now, this is a truly fantastic safety net. Basically, under unique circumstances, like, say, a diagnosis of a critical or terminal illness, the company will literally waive your future premium payments. So it keeps your coverage totally active exactly when you need it, even if you can no longer afford to pay. All right, the home stretch, Section 5, Essential Buying Strategies. So, first things first, how do you actually buy this stuff? Well, you have two main execution routes. Buying online through an official web portal is awesome because you can directly compare several products and their unique features right there side by side. On the flip side, buying offline means you physically visit the nearest insurance branch with your KYC documents in hand to fill out the application. Or maybe you work directly through an insurance agent. And honestly, both are totally valid. It just comes down to your personal preference for digital comparison versus having that in-person guidance. Okay, here are 5 golden rules straight from the consultant's playbook. Number 1, buy early. Seriously, get in early to lock in those lower premiums for life. Number 2, choose yearly premiums over single pay. It's just so much easier on the budget long term. Number 3, accept premium hikes positively. If a medical check reveals some hidden health issues, a hike is totally standard practice, so don't panic. Number 4, don't overbuy add-ons. Only get the riders you actually need. And number 5, well, this is actually the most critical rule of all, so let's zoom in on it. Disclose all material facts transparently. Guys, I literally cannot emphasize this enough. Never, ever hide habits like smoking or drinking. Yes, they will find out. Your premium is calculated based on these exact lifestyle factors. If you hide them, it will almost certainly result in the total rejection of your claim later on. I mean, hiding facts completely defeats the entire purpose of buying the policy in the first place. So please, just be 100% transparent. Okay, let's bring this explainer back to its emotional core for a second. Beyond all the industry jargon, the annoying medical tests, the premium math, it all really boils down to one simple fact. Term plans promise you peace of mind. The ultimate goal here is just ensuring that the people who are dependent on you can continue to live comfortably, even in your absence. So, the final question I'll leave you with is this. Are you ready to secure their future today? Take the strategies we've explored in this playbook, sit down and honestly assess your family's needs, look at the numbers, and go get them protected. Thanks for exploring this topic with me, and I'll catch you next time.